Hi, I'm Owen from Rask Australia. Thanks for tuning in to the Rask Network.
Before we get into today's show, there are a few things we have to go over.
Firstly, what you're about to hear and see is limited to general information only. It's not personal financial advice like you get from a financial planner. Also, it's important to remember that past performance is not indicative of future performance. That means that anything that's happened in the past, or we say today, is not necessarily going to reflect what happens in the future. Lastly, please consider that any of the guests or myself are featuring on this program may have a financial interest in some of the products or shares mentioned. That's enough from me. I hope you enjoyed today's
Kerry,
program.
welcome back to the show.
Thanks. It's great to be back.
Yeah, it's been a while since we spoke. I think the last time we spoke may have been on Self Wealth Live, where we talked about some of the indicators for 2023. It's always refreshing to get your take on things. But I thought maybe to have a bit of fun to kick today's session off, I'm going for a man versus machine, man versus AI. I asked Google Bard for a list of the most important economic indicators, and it came up with 10, and they seemed okay. But I'm curious, we hear a lot of economists and commentators in the news. If I was to give you the same question, which is like, what are the most common economic indicators that you use to form a view around what's happening in the world, what would they be?
It's a good question. I'm a little scared that if I get this wrong, I'm going to be replaced by AI and Google Bard. I feel like this is more of a job interview. I hope my boss doesn't listen. No, it's a great question because first off, we often don't think about what are the 10 things we watch. When I speak to clients, I think about how I would talk about the economy broadly and relates to markets. So it was an interesting exercise to go back through and actually look at what we produce and how we look at it. And so when I did that, I broke it down to thinking about, well, what actually contributes the most to the economy. So, the first indicator we want to look at is actually GDP growth. We want to look at how that's moving on an annual and a quarterly basis to get a sense of momentum in the economy. But that's backward looking, it's going to tell us where we've been. So the next thing we look at is obviously the labor market. So we want to see how people are feeling, what's the job prospects, because that's going to feed into a lot of other things. So there we're looking at the unemployment rate and we're looking at wage growth. So two things that are very relevant in today's context. We're thinking about inflation as well. Related to that, labor market. So I'm up to 3. We're going to look about the consumer. So obviously there we're going to capture retail sales figures. Oh, yeah. Not perfect in terms of what it means for growth, but it's the best and most frequent number we have around that. And a little bit, I wouldn't necessarily group these together, but I think in the Australian context, I'm thinking about these numbers in the Australian context. Related to that is obviously housing, because it's such a big momentum factor in terms of people's sentiment towards spending money and how they feel and that wealth effect. So we'll look at housing there in terms of prices, constructions, and then financing as well. So that brings me up to 5. And I think housing is important because it's about 7.5% of GDP as well. Right. Going to look at the corporate side of things because that investment outside of housing is another big chunk of it. So there I'd look at private capex and see when the spending plans are coming through in terms of how businesses are feeling. And then on the external side of things, so we've captured all the domestic economy. We want to look at trade. So we're thinking about obviously the current account balance and then obviously the trade balance. Again, very important. We think about Australia, given how open we are to the rest of the world, how reliant we are on commodities still in terms of what's happening globally. And the last 2, pretty straightforward. Obviously, what all that means for inflation and then what that means for monetary policy and the rates outlook. So those are the broad 10 economic indicators that I would look at. And then obviously, if we were thinking really trying to capture what's happening in the economy, we would look at the dollar, we would look at bond yields, and we would look at the equity market as well. But that would be 10, 11, 12. Sorry, 11, 12, 13. So I've stopped there.
Yeah, it's clear that there are so many, right? There are so many important factors. And it's like from the JP Morgan asset management side of things, how, you need to be so well resourced to be able to answer these types of questions, to be able to speak on them. We're just talking off air about how many things you do in the media and what you have to comment on. So Google Bard's answer was nowhere near as polished as that. It was just basically, here's the list of 10. But then
I'm safe.
You're safe. So man 1, machine 0. But for the second part of this question, what I also asked Google Bard to do was I said, hey, okay, give me some forecasts for some of these things and tell me what you think. And I think you were right when we were speaking about this. It doesn't always capture the most up-to-date information. So it was trying to make forecasts for the year ahead. 2023, it thought was the year ahead. And it seemed reasonable, but some of them were very, very wrong in terms of what data it must have been relying on or something like this. So can I get you to step through maybe the 5 things that I thought were really interesting to our audience, which are, I'll rattle them off and then we can spend a bit of time on them. Inflation and rates, so those are the first two. Retail sales, which you mentioned before. Housing starts and unemployment. Seem like they're making their way through every economic update right now. They're like in the first paragraph. We can take these however you like and we can go back and forth, no rush, because this is like kind of the meat of what our audience is thinking about.
Yeah, and they're all related. They're all going to have some impact on the others when we think about how those things actually move together. And that exercise, because, obviously the data and how up to date the data is that's feeding into some of these AI engines is limited. It's an exercise to ask it. If it thought the year was 2022, what's going to happen in 2023 with hindsight to say, man, actually things didn't really transpire like the data showed it would. And that's very been experienced. We look at how markets have behaved and the economies have behaved around the world this year. So maybe that's something we'll explore more.
Yeah.
Sorry, digress from your question.
No, that's fair.
Just taking those, in turn, I mean, inflation, that's the big one because that's the thing that's sort of driving markets at the moment and thinking about rates as well. Our view on inflation, and this is again in the Australian context, is lower. I mean, we had inflation peak at sort of 8.4% end of last year. The monthly read that came out this week, it's under 5% now. That disinflationary trend is very clearly there. So it's easy to say inflation should be lower over the next 12 months. The things that matter is just like how fast it comes down and where it actually ends up. Does it it goes back to 2% for the RBA or 2 to 3% for their policy target, or does it sit at 4 and not the 5 it currently is at? So lower is a bit of an easy answer. It's really how low and how quickly it gets there is what actually matters at the moment.
Have you been surprised by the direction of inflation so far? Like we're recording this just after halfway through the year, maybe 3/4 of the way through. Have you been surprised?
It's been easier in the Australian context because we can look at what's happening in the US, and that's sort of further advanced in that disinflationary process. They were, for a lot of reasons coming out earlier of the pandemic and releasing the restrictions and everything else. And so you could kind of look at that as a template and say, what's there been an experience of people's behavior to these? I mean, some of the fiscal response was different, but again, if you looked at that and compared to what we've seen in Australia, it's a very similar experience in terms of that very high peak in inflation, not as high as we had in the US, but then the path down has been a little bit more quicker than we had been expected. But again, we're having that same debate now about, just how far going from 8 to 5 or 8 to 4.9 was pretty easy. Getting back down to sort of the 2 to 3 is going to be a lot more tougher in terms of some of the structural changes that we've had over the last few years, for example, in the labour market, which may keep inflation higher.
I was going to ask you about what that means for interest rates next, but maybe there's the conversation, wherever you want to go next, could be unemployment or something like this, because from what I've been reading and what I've been hearing is that's something that seems to be persistent. Like it's been a low unemployment rate. Yeah,
I mean, there's these, academic relationships you can go back and look at. So the one that's sort of most prevalent at the moment is the Beveridge curve, which looks at the number of sort of vacancies relative to the unemployment rate, and you generally get this downward shift as these things move together. But those relationships have changed. So they're showing that you can have much higher vacancy rates, and the movement in the unemployment rate is not as great. So it's kind of looking back at history should tell you one thing based on the data we have and what we're actually experiencing as a difference, because we've had either, a lot of people leave the workforce for various reasons, or we've had the inability to get new supply of labour because of, border closures. So the first is relevant for the US context, where you had a lot of the over 55s leave the labour market and the participation rate declined quite severely. And then in the Australian context, it's the other one where we have a high participation rate, but we haven't had a new supply of labour because we had very low net migration. Those things are changing and coming back, but there's no guarantee to say what extent they'll go back to the pre sort of 2020 levels. Right. So those structural changes are really shifting things. And while we do expect the unemployment rate to move higher because you're going to get less demand as the economy softens, in our view a little bit, more supply of labour as people come in, that means that you do get that unemployment rate nudge up. And, an unemployment rate is actually a healthy thing because you have people just moving around in the labour market. So people are always unemployed at some point. Having an unemployment rate that's sitting at, 4% or something is low historically, but it's not a bad thing to have unemployment in the economy. I think people forget that. So it is a case of thinking about the unemployment rate moving higher, but those structural reasons may mean it doesn't go back to the peaks that it did in the past when we had a softening in the economy.
Do you So that's really interesting. Of course, the net migration figure is really interesting. I was reading something the other day that fewer Australians are leaving, which is having the consequence of seeing like an increase in population. With a softening economy, like how does that say to you that maybe this factor that we're so focused on, being unemployment, has the potential to surprise a lot of people and a lot of commentators?
Yeah, it's a funny one because, again, it's a lagging indicator. It's telling us what's happening. It's not sort of, a survey or a forecast. It's basically telling you how things have been in the past.
Yeah.
And so it's one of the things where if you look at charts, you get these like pretty big jumps in unemployment rate because the unemployment rate doesn't go up until suddenly the economy is much, much worse than you actually thought it was. So it can be one of these things that does surprise in terms of, unemployment rate's like pretty low or it's pretty steady and then suddenly it jumps up massively. Again, we wouldn't think that leap that you might see should the Australian economy fall into recession would necessarily be as large, either for it was really hard for people to find workers for a long period of time there. They'll just maybe do labour hoarding and keep those people on the books. You could see the shift in how people are actually working, whether it's between part-time and full-time or the number of hours they work, which all indicate people actually want to work more because, it's getting more expensive to live. So these are the things that we could see the unemployment rate. Yeah, it could surprise in the upside, but maybe the upside isn't as high as it was in the past. And I think that's the more important factor because if it doesn't get so high, when things start to improve, you got to think about how far it can fall again.
This is not in the list of 5 that I just gave you, but
bonus round.
Yeah, bonus round. Here we go. We've seen business confidence and consumer confidence. That's been. I mean, you're the expert here. At least from where I see it, like anecdotally, say, business confidence seems to be taking a hit. How that's like, as far as I'm aware, it's like a forward-looking indicator. Confidence impacts spending, impacts investment, etc. How about that from the perspective, we've got retail sales in here, so maybe we can tie this together. How does that fare as we flow through, I guess? Yeah,
I mean, it's you look at the correlations between some of these surveys and what actually happens in the economy. They're much tighter for some markets than they are for others. So again, keep referencing the US, but you can look at the PMIs for manufacturing or services in the US or the ISM, which is a business survey, really closely correlated with how growth goes. They're not so tight in the Australian context. Like the PMI numbers that come out for Australia were very, very weak, despite we went through a period of quite decent growth. So they're not as meaningful. When it comes to that, the business confidence numbers that come out, so they get produced by SNAB, right? They look at the business confidence. It's actually the business conditions index. There's 2 that come out, which is actually more important for thinking about where economy is growing. And often there's a bit of a divergence between, how are things right now, conditions, and business is like, actually things are looking pretty good, we're okay with this. And then how do you think things are going in the future, which is your confidence? Well, there's uncertainty around China. We don't know what that means. Either have trouble finding labor or we're worried about a softening economy. And you get that divergence. And generally there's a gap there, and not always does that gap actually close. So business conditions actually continue to be okay, and everyone has that sort of relatively maybe pessimistic or sometimes more optimistic view on the future, but it doesn't relate so much to how the growth experience actually goes through. So there's a merit in looking at them. I think there's also a caveat in terms of how reliable they are in terms of what the actual experience is later. And similarly on the confidence side, when you break it down, I think it's more important to look at, what's driving that confidence. Is it household financing? Is it, things like, should I buy a house? And it's those ones that are really important. And it's when you see that weakness in things about how do you feel about your household finances and how's that affecting your confidence as a consumer, that's going to be the bigger one that drives it. So it's really important to look at what's driving those indicators more than just the headline level as well, because confidence is pretty low in Australia. But people are still spending money, man. Look at the retail sales numbers.
Yeah, well, that's it. That's what I was going to say next. But maybe it's just the business owners I speak to, they're always negative.
Well, I think that if you stick your head above the parapet and say everything's great, I mean, you're just like, and the economy is softening off and everyone's looking at higher rates and, mortgage payments going up and you're there going, no, things are great. You just, setting yourself up for a bit of a hit.
Yeah, indeed. So retail sales, you mentioned that. Some of the companies that are on the ASX, earnings, we've just had reporting season. Some of those companies have come out and there's been mixed results. You got the likes of JB Hi-Fi saying, we're going to take market share, we're going to invest aggressively. And then others have come out and said, well, actually, the results weren't as good as we'd expect. How do you see retail sales, broadly speaking?
Yeah, I mean, definitely in terms of the earnings season, that resilience in the consumer was definitely a theme that played through. And again, come back to that net migration, that plays into some of how these stocks are thinking about the growth prospects out there. In terms of the retail sales, I mean, if you look at a chart of it, it's just been all over the show. The year-on-year changes have been just swinging around because of all the experience of the last couple of years. So that makes them a little bit harder to, is it catch up or is it unwind from what's happened in prior quarters? There's a bit of volatility in the monthly numbers. But I think when you look at them today, actually, the latest number on a year-on-year basis was about 1.5%, if not a little bit under that. That's low. I mean, if you look at sort of the pre-2020 kind of period, retail sales are somewhere around sort of maybe 2-3% for a pretty consistent period. So actually, if you said like for me, 12 months now, what do you think the retail sales numbers will be? On a year-on-year basis, I think they're going to be more like that sort of 2 to 3%, not the sort of 1.5% they are at today.
Interesting.
Because you'll see a little bit more stability and a lot of that data volatility that we've had over the last few years come out. And we can get onto it, but there might be reasons why consumers are feeling a little bit better in a year from now.
Okay, well, we'll come to that in a second. Okay, one extra one that I've got on here before I get to interest rates was housing starts. We've heard a lot of really kind of scary headlines around builders going bankrupt, people not being able to, like borrowing capacity down 40%. So mortgage brokers are telling me, people not able to buy, people not able to invest in their properties. Some of the big builders on the ASX even saying, it's a bit soft at the moment. We're trying to manage housing affordability, et cetera, et cetera. I guess maybe the first question, based on what you said before, which was really interesting to me, is how much emphasis would you place on something like housing starts or dwelling approvals? And then is that something like that you can use to infer something about, maybe I think you said 7.5% was the housing?
Yeah, if you break down GDP, it's about half of consumption and then about 25% of government spending. This is GDP by expenditure.
Right.
And then you think about exports and housing, each to be about 7.5% each, and 10% roughly is investment ex housing. So that's the big breakdown of the economy if you look at just like the last 4 quarters on average. So yeah, it's 7.5%ish. So it's not insignificant, and it can have that impact on the economy. I think it will actually be a drag on growth over the next 4 months in terms of what the housing market is actually doing in terms of that investment side and residential investment. But you're right, the forward-looking indicators are there as like, well, how easy is it to get financing? And yet, okay, rates have gone up. Banks are probably thinking about their loan loss provisions and their balance sheet and what protections they need to have in place. So maybe getting financing is not so easy. If I can't get financing, am I going to go out and getting a building approval? Probably not. So obviously that's going to come down. If I don't have a building approval, then am I thinking about commencements? Well, that's just housing starts in Australia, commencements.
Yep.
Probably not. And then obviously completions is on the back of that as well. So if I don't start, how do I finish? So those things all sort of follow through with some degree of lag between them. There has been some, again, sorry, terrible answer, but a lot of volatility in these numbers in terms of either the times it took to process them because people weren't, in the office and they're working remotely, and maybe it was a bit hard to make sure people were doing their jobs, or the volumes of things were coming through. So there was a lot of big numbers that fell and then jumped up and came down again. And then most recently, the number on the housing starts was really weak. And you can break it down to think about multifamily and then sort of single dwelling or residential. So obviously apartments versus single houses. And the multifamily part is really volatile, jumps around a lot. And so when you take that out and just look at residential dwellings in terms of single dwellings, there was barely any movement in the month-to-month number. So things, when you look below the surface, are a little bit more steady state relative to that. But more broadly on the property sector, I mean, there's definitely going to be that weakness in investment as the impact of higher rates are still flowing through. These long and variable lags of monetary policy we always hear about are definitely there. I think that you're seeing some stabilization given what we're seeing in the housing prices coming through, but hardly thinking about a massive recovery at this point. I think it's more about the supply and demand dynamics in the housing market and the great system we have in Australia of auctions and how no one really knows what houses are worth until the day they actually sell.
Yeah, indeed. I chat a lot to my mortgage broker, and he's like, well, maybe if like interest rates show any sign of being like permanently, plateauing, or even some weakness that we could maybe see them falling in the future. He's like, I think that just puts a fire under a lot of people that have been trying to borrow and been, maybe ready to purchase, upgrade, downgrade, whatever. So I guess the focal point for a lot of people when we have these macro conversations is interest rates. Like it kind of like, we've got all this stuff around the outside, but then what does that mean for credit? Like, what does it mean for my ability to spend confidently and for businesses to borrow and all this type of stuff? So interest rates, the last of the 5, where do you see interest rates over the next 12, 24 months, however you want to frame that?
Yeah, I think that's absolutely the right way to think about it. If you're planning to a large purchase, you think about how am I going to finance that? How am I going to keep paying my mortgage? Which way are rates going is going to be pretty important rather than maybe not so much where they are today.
Yeah.
And so if you do think maybe the RBA is done or at the very end, you have more confidence around saying, well, I'm going to make this large purchase and I think I can finance it because I know it's not a 1-year investment. It's something I'll live in for 5 years or 10 years. And therefore, the payments will come down over that time. So I think that is the right thing to think about. And I think the RBA is also very aware of that. So when it comes to interest rates over the next 12 months or even 18 months, we look out to the end of 2024, it's lower. I mean, I think that's the way it goes. How much lower, you can start to get a little bit of debate because I think there's prospects for saying, they could get another rate hike in this year if we don't see that inflation number come down enough for the RBA. But I do think they'll start cutting by September of next year. If we're sitting here today, I think you would have had the first rate cut. So that means that either rates are where they are today, but you've had that one hike and you've had one come down, or you're actually 25 basis points lower than where you are today, assuming they don't do any rate hikes. That's really semantics. I think the more important thing there for a lot of investors and for markets and what's being watched is that you're going to enter a rate cutting cycle and the end of the rate hiking cycle. And that's really what markets can look for, because as soon as they get any signal from the RBA or the Fed or anyone else around the world that done with rate hikes, that's as high as they're going to go. We're thinking about cuts now. They're going to reprice really quickly for that. That's going to drive investment in a big way. And you can look back historically and look at, say, how markets behaved after the end of the last rate hike to see that a lot of that gets priced in very quickly. So again, I think rates will be lower a year from now, but the more important part is that you'll be on this rate cutting cycle rather than a rate hiking cycle. And once that starts, continues to move downwards for some time.
I remember we spoke about this, I think it was last time or maybe the time before that when you came into the studio, how important that initial period is when the expectations are reset. And I think some people, financial advisors, asset allocators at the moment, are thinking really long and hard about how far away are we from that moment. But in the US, recently we saw interest rates go up at a time when we've seen inflation fall quite meaningfully. So you mentioned there, you've kind of said like rates are lower with a caveat that maybe there's scope for one more if we see inflation persist. Would that be fair to say?
Yeah, I think this is when you get to the really nerdy conversation around the neutral level of interest rates for an economy. And that's kind of what's happening in the US at the moment in terms of, a bit disappointing they talk about it at Jackson Hole, but it's something that's very hard to measure. Like, what's the appropriate level for interest rates in the economy for it to just stand still? Where's neutral? If you're sitting in your car that's not going forward, not going backwards, what's that level of interest rates? And you can look back and say, in the US context, they think the long run view, this is the Fed, the Fed thinks the long run view on interest rates is 2.5%. So maybe they think the neutral level of interest rate is 2.5%. 10 years ago, they thought that level was 4%, right? So now you have sort of more changes around the inflation outlook. They may be thinking, well, we need to have higher level of neutral interest rates. Maybe it's going up. That means to be restrictive, actually the interest rates need to be higher than we thought they needed to be. And that's kind of why we're still seeing interest rates go up, even though you're seeing that momentum soften in the economy. The growth side of things has been surprising to the upside. The risk is there that if there's too much aggregate demand at the very basic level, too much growth means too much inflation, and they still have to work harder to squash it. So it kind of goes back to the argument, if rates have gone up 500 basis points, why is the economy still expanding? Because they actually need to be tighter to slow the economy because there's a higher level of interest rates that are neutral in the US. And I think the same debate is happening in Australia to a degree as well. So, where that level is, how much tighter you have to get. But again, if we get one more rate hike from the RBA, if we get to another 25 basis points higher, I mean, that's very different to like 6 months ago where people were like, oh, interest rate in Australia could be 6%. It's not peaking out at the same level. So it's definitely having that impact, and those expectations are changing. And again, long and variable lags, we're seeing the consumer has been resilient. It's going to start feeling that pain with those higher mortgage payments coming through in the second, third, and even the fourth quarter of this year. And so it's all going to create that drag on growth. Unemployment rate's going to start to go up a little bit. People will be a bit more hesitant around how they view it. And that's going to lead the RBA to really signal the end and then think about rate cuts to get growth going, because their growth forecasts aren't really living up to potential for what Australia could deliver.
At the beginning of the year, everyone was talking about the interest rate cliff or something like fixed rate cliff or something like this, and those would be rolling off around about right now, August, September.
Yeah, it was mainly second and third quarters of the bulk of it.
Yeah. So I guess we're right in the thick of that now. And so actually, I've got a follow-up question to what you just mentioned. Where do you see the neutral rate in Australia?
Well, I think in real terms, it's slightly above zero. So that's really easy to come to. So that means that, if the inflation target is sort of between 2 and 3, say 2.5%, that means we think the real rate has to be a little bit above zero, say 50 basis points. And so the nominal rate is about 3%.
Yeah.
So that might give you a long run view. Those things around what the neutral level of interest rates, or R star as it gets referred to, structural changes, very slow moving around how we see things, not something that's going to change week to week, and very, very difficult to measure. So, you can go back and do some econometrics or go to various websites where they actually produce it. So in the US, you can go and look at the Fred website and they'll give you estimates for what it is, but it's something that's very difficult to measure until you have hindsight on what it actually was. So the risk is that it's a little bit higher in Australia, and that those real rates have to be a little bit higher to justify that slowing in the economy. But I think this is something that's going to be debated. It's not going to matter for the immediate future. What the markets are going to be focused on is, have central banks finished hiking rates? When's that first cut coming?
Yeah, absolutely. Okay, so interest rates have gone up in the last couple of years, to put it mildly. Stocks have gone up recently. Property seems to be extremely resilient, shall we say, in Australia. Have you been surprised by that?
Yeah, I mean, of the two, has the equity market or the housing market been the more surprising factor? I think it's the housing market. Our view was that Australia was going to avoid a recession, largely because we had positive net migration and we didn't see the same weaknesses that we saw present in other markets like Europe or in the US. That's still largely playing out. I mean, the growth outlook's pretty soft, but we didn't think about the housing market being something that was going to turn around while rates were still going up. So if you look at any housing market cycle from peak to trough and then back up again, they're quite V-shaped, but you don't see that turn until the rates actually start being cut. So that turn coming through when rates were still rising was quite surprising and something that didn't happen. And again, it comes back to, I think, some of your points earlier, where people were either cashed up, saw house prices fall and took the opportunity to buy something, and they were just in a position where they didn't have to worry about leverage or financing so much. So, I mean, there's definitely anecdotal evidence of that in certain eastern cities in Australia. And then the other thing that was coming through was the fact that, there's just big imbalances between supply and demand in housing in Australia, which is supporting the long run view of the market. So people are eager to step in. If it continues, though, obviously we're seeing those monthly numbers on property start to improve. I think we're 6% off the peak at the moment. I mean, as we get to the warmer months, you get more supply coming through. Maybe that appreciation starts to slow down a little bit. It takes a little bit longer to get back to that prior peak than what it was, especially at those higher interest rates. So I think we definitely frame it as more stabilization in the housing market than a recovery.
So I guess then the question is, does that mean if it's a stabilization, maybe property prices, maybe they can tread water for a while?
Yeah, they'd probably stop declining. They might go up a little bit and on a monthly basis, but it doesn't mean that they're going to start to shoot back up to where they were, I think, is our view of it, rather than thinking about markets saying, well, everything's starting to turn around, it's great. But again, coming back to your earlier point, if the RBA thinks the housing market's too strong and that's something they want to slow down, and they know they can do that through interest rates, they think that's going to create too much inflation, given some of the core pallets that are related to building, which is becoming softer, they can sort of say, housing market's too strong for us. We're worried about the impact that actually has on broader spending. Let's keep rates higher.
So my next two questions, and I was just looking at them because these are questions that are very loaded in the sense of like there's a lot to it. Like I
expect nothing less.
If you thought the AI conversation then mixed with the most important economic indicators was a big question for Kerry to answer. The next two are kind of the two that are, I guess, because they bridge on geopolitics and these types of things. And we've had a lot of people on the show talk about I think they called it like a multipolar world or something like this, where the US has been the superpower, but now obviously China is a superpower and our regional neighbor. And some people, a lot of people who are investors, are allocating a lot of money to what would historically be called emerging markets or Asia generally. And I'm curious, like JP Morgan Asset Management globally, you guys got a huge team, been doing this for a very long time. How you see the implications of that, broadly speaking, the kind of the rise of China alongside the USA, And maybe then after that, we can dive into maybe the investing implications. But just generally speaking, how do you view that?
Yeah, I mean, it is such a big question, and we have written about it extensively over the last few years. I mean, we actually wrote a paper called The Multipolar World.
Oh, right.
And we've had different groups within JP Morgan have published their views around what this actually means. I think that to summarize and to start, I think it is that multipolar world. We push back a little bit the idea when we get deglobalization. Oh, it's deglobalization. Because globalization is a really big term. I think most people just simply think about trade and goods. You know, they're maybe in the in the US, China context, they're thinking about the sort of tech war, if you want to call it that, or the strategic positioning and dominance in tech and data, and thinking, well, that's deglobalization. That's a part of it. If you look at how trade globally has gone since 2008, 2009, since the GFC, it's kind of flatlined and come off a little bit. If you look at how services is being traded around the world, that's continued to rise. You know, as we become more digital, more data dependent, that just means there's more services being traded around the world, more offshoring of many aspects of working life coming through. That actually grows. And then you can think about how instantly global we are in terms of thinking about the financial markets as well. You know, the dominance of the US dollar in the financial system, again, being challenged, but it's not really changing that much, right? So that's why we think about deglobalization as something that's multifaceted. And what we're really thinking about in terms of what a lot of people mean is just trade flows and the reorganizing of supply chains and whether we're going to see this big rupture. And so a multipolar world is definitely something we could see, you know, along political lines in terms of how, you know, countries are operated. You can think about West-East, or you can break that up to sort of democracies versus autocracies, or, you know, any way you want to think about it. But it doesn't mean that a level of trade is necessarily going to fall. It's just going to be reorganized in different ways. And it is going to have some longer run impacts, but they're very long run impacts. You've already seen it start to come through from, you know, the trade wars under, you know, 2016 or 15 when they come through, when the US really started hammering tariffs on China. A lot of that point in time, businesses started to say, this looks like a bit of a risk. Let's start moving our supply chains into Vietnam and other parts of Asia. And you've seen them benefit from that. So that deglobalization debate is something that's going to keep going for some time now. And I think it's something that's going to be very important when we think about how you allocate to these markets in the future.
It's really interesting. Like, just in the last couple of weeks, we've been here at Rask, had so many more conversations with brands out of China that are looking to Australia as an opportunity, or Asia generally speaking. Brands that we probably never would have come across 5 years ago. And now they're looking here and they see opportunity down under. And it's been really surprising how they view the Australian context and how we view them, and the ideas around trust and commerce, how it is done. Generally speaking, that's been really eye-opening to me. But we've had a lot of people come on the show, Kerry, and they talk about, and these are asset allocators, CIOs, like chief investment officers, really like some of Australia's top financial advisors, all different types of people come on the show and talk about their view on emerging markets, generally speaking, whether it's India, China, any of those types of markets. And some of them have, I would say, over the last 3 years in speaking with them, have built their conviction in those markets. Some people say that it's going to continue to be the engine room for the next 20 years, and they're allocating heavily there. Like, you've got a global equities portfolio, they're allocating substantial assets in that sleeve to emerging markets. And I guess I'm just curious on your view, generally speaking. Maybe it's a question around, well, how much growth comes from these markets versus what we traditionally know with developed economies or the West, so to speak.
I mean, caveat this, at the economic level, absolutely right. There's going to be more growth coming out of the emerging world than the developed world because they're emerging. They get the benefit of like all the productivity enhancements that are going to come through. They have better demographics. They're going to harness this demographic dividend, they call it. I mean, that dividend doesn't exist in China anymore because the demographics are going the other way, but places like India, it absolutely does. Look around Africa, 100% does. Even parts of the Middle East, they're going to see that growth rate because they have that better demographic profile. And so if you think about what drives growth, it's, you know, labor markets and people, capital investment and how productive they are. So as they build that productivity, as they have better workforces, and as they get that investment from other places around the world, that capital, they're going to grow faster. The difference is, though, that economic growth does not equal market growth. Look at the US. It is an aging economy. It's slowing down. What's the equity market done this year? It's gone up. because it's not the market is not always the economy. So I think that's the big difference. We would definitely agree that if you're thinking about a global equity exposure, it absolutely has to have emerging markets in it. It's generally largely been underweight for most people in Australia in terms of their global exposure. They tend to think about the US, and it's 50% of developed market indices, so they get a big exposure to that. That's some of the risk at the moment because it's highly concentrated in a few names. When we think about emerging markets now, though, I think the breakdown is more emerging markets and emerging markets ex-China. So it's how your view on China is very separated from the rest of the emerging world because there are very different drivers of what's going on. The rise in India being an important part of that. What we're seeing around ASEAN and the rest of Asia because of some of these relocation of supply chains, because of the drive for chips and semiconductors, benefiting Korea and Taiwan. It's really going to become much more nuanced in saying, I can't just have emerging markets exposure. I need to actually think about what parts of the emerging world are actually going to benefit, and maybe where some of those geopolitical risks lie when it comes to thinking about how the world operates as well. So we're definitely seeing that more often. People are treating China separately because it has separate drivers. It comes with additional volatility, but also really strong potential as well. So if China, comes out with some big block stimulus, not that we think they are going to, but if they come out with something like that in the next few months, the equity market there is very cheap and it's going to go up a lot. So we have this view of people can't write off China given the potential for it to come back, but they might have a different allocation towards it given the overarching geopolitical risk that's starting to creep in and how people are treating it. Whereas if they look at the rest of emerging markets, they really should be thinking about demographics that are coming through, the long run growth,
structural growth,
improvements in GDP per capita, the consumption that's going to come through, all those things which are really going to benefit in terms of being a much stronger improvement to your portfolio returns. If you want to again think about an efficient frontier where emerging markets sit, usually in the top right, they drive a lot more return with a little bit more volatility for your portfolio, but they're back in how you get your portfolio returns higher over the long run.
I'd imagine you guys, like the entire JP Morgan Asset Management brand, not just here in Australia, talk a lot about this. So I'll refer people to the website. Like you said, there's a lot of you may have spawned the idea of multipolar. Maybe
I don't think so. That's been around for a long time, but it's a good way of thinking about it rather than thinking about just deglobalization. It's actually the world's going to be fragmented more, but not fully fragmented. Again, coming back, there's too many global issues that can't be resolved. Thinking about where commodity prices are, how people want to address decarbonisation, the fact that climate change is a global issue, not a national issue. All these things are going to keep the world together to a certain extent. It's only going to be aspects of deglobalisation that really come through in terms of trade and maybe in terms of the dollar dominance. But again, very long run issues. Sorry.
Yeah, that's really interesting that you phrase it that way. I haven't heard it put that way around. These issues are global challenges, so the world basically has to be united to some extent, right? We have to, because we know decarbonisation is a massive issue all around the world, right? Those are really fascinating conversations, and I think that for anyone listening to this, and if you don't have exposure to those types of markets, now is the time to start thinking about it. Better time than ever to start thinking about it. But maybe we'll finish with a bit of a game. We started with a bit of fun, a bit of tongue-in-cheek. My final thing is, I feel like I've maybe stolen this from someone. I'm sure someone's done this game before. But let's call it higher or lower the macro addition, Kerry. So I will just give you 5 variables, and then you say higher or lower. If you want to add any context, for sure, just going for a bit of conviction here. But we are always going to say refer back to the JP Morgan Asset Management website for a proper deep dive.
Don't go back and listen to this afterwards to see how wrong I was.
Yeah, do not do that. Maybe in 2 years it will show up in Google Bard or something like that. But go check out the website. We're saying off air before as well, you're doing a bit of you've got to go on the road again. You've got to do your big macro updates for clients all around.
Yeah, a lot of what we've discussed is coming out in our long-term capital market assumptions paper, which is our 10 to 15 year view of the world. So all those things about China, all those things around diversification that's been a big problem, thinking about the broader macro impacts of how inflation works and what it means to policy rates in the long run. It's all included in there. And so yeah, it's a hefty read at 100 and something pages, but there's usually a good 2-minute summary on the website or something you can watch. And
that's published once a year, if I'm not mistaken. Is that right?
Yeah, it takes about 6 months or 9 months to actually do all the work. So it's
I always say on the show that these are the best reports to get your hands on if you spend, even if it's just a few days of your year, to tap into the research that you're doing, to read through them and have an understanding of just what are the machinations out there beyond the shores of Australia if you're stuck in the vortex of Australian news.
Yeah, if you're an investor, you're thinking long term and getting away from the daily sort of news grind around markets. I mean, that's really what matters, to be honest.
Yeah, absolutely. Okay, so higher or lower? Let's go. We've got 5 things. Kerry, higher or lower price of a 2017 Toyota Hilux in good condition?
What colour is it?
We'll go standard white.
It's lower.
Lower.
Yeah, if you said red, maybe I would have gone up, but white, no.
Okay. We'll say US stock market, higher or lower? We'll go S&P 500.
Can I say flat? Because I think it's, probably not going to go down. On that, I think there's definitely more of a by the weakness in terms of the market performance from here. But I mean, it's going to have to recover to go back to the 20% gains we already saw this year, because it's down about 4% from that. So I think it's going to be a case of buy the weakness when it comes to the US. So flat to maybe up a little bit.
The Japanese stock market has done very well in recent times after a bit of a hiatus, we could say. Higher or lower?
Higher. I mean, it's I call it the Vegemite market. People love it or hate it over the years, but it's definitely getting its act together in terms of a lot of positives around the economy. Inflation seems to be structurally higher. Bank of Japan slowly moving away from those ultra accommodative policies, which should help the financial stocks. The currency is very weak, which is helping the exporters. And there's also those sort of corporate governance changes that have been building since Abenomics in 2012, which are still coming to the fore. So one of our higher conviction ideas would definitely be China at the moment. Japan at the moment.
Great. Okay. That's good. I actually like that outlook. Thank you very much. Number 4, Aussie shares, and we can take whatever index, but Aussie shares.
Just look at the ASX 200. I'd have to say, if we're just looking at the price returns, obviously you get dividends if everyone loves those. But we've had a pretty middling market. I think it's like sort of 3.5%, 4% so far this year through the end of the month. It's not been something that's going to strongly turn around. The only thing that I think would see a big lift higher for the Australian market would be if you got a big policy announcement out of China that was really going to see demand for commodities rise massively and lift the resources names. I mean, the earnings revisions haven't been great that have been coming out lately. So I think it's a case of you might hold on to the gains you've had this year, but not expecting much more.
Okay, so maybe flattish. Yeah. Finally, a diversified all-of-market Australian bond index. So I'm just trying to say the Australian bonds, generally speaking.
I mean, where yields are today, I think you could do a lot worse than going into just any sort of core government bond index, because, again, if you have lower inflation, falling rates over the long run, it doesn't mean yields going to fall. You're going to lock in those higher coupon payments that are going to come through. You're going to get that capital appreciation from the prices falling. It's very difficult to look past fixed income at the moment in terms of you basically want to be, at this point in the cycle, owning things that pay you income. Yep. When there's the big questions around how highly valued some parts of the equity market have become. So income paying assets are very much obviously defensive, but the fixed income market is looking the most appealing it has in a very long time. Even if there's been a lot of volatility in those bond yields, obviously they crept up in the last month or so, but they've started to come down again. So I think that fixed income is from a risk-adjusted return point of view, a very strong proposition at the moment.
I think so too. So we've got Toyota Hilux. You said lower. Is that correct? If it's because it's white.
That's a very, very, just academic-based thesis on that one. Yeah.
US stock market, flat. Japanese stock market, higher. Aussie shares, flat-ish. Bonds, higher, I guess, or it's a bullish outlook for you from here.
Yeah, I think just on the US one, it's flat to up from this point, just because we've had a pullback in the last month or so. So we have to get back on up. But I think we have to go back up to 20% gains you had and then beat that. So I think that's a bit of an ask.
Yeah. Okay, well, that's pretty good. And I'm always I always feel more positive after I speak to you, Kerry, because I always feel like
I am too optimistic sometimes.
But you bring the common sense, right? But you look through a lot of the noise, because that's what you've got to do, right? You've got to look through what's happening this week, this month, and look beyond that and give a really rational take based on a lot of literature and a lot of research that you guys do. Once again, I'll direct everyone to the links. They'll be available in your podcast player, so you can go and check them out. You can head to the website and find Kerry's writings as well. So, mate, thanks for, I know it's only for you. Your office is about 30 meters from our office, which is absolutely spectacular. But I really do appreciate you taking the time to come in.
No, thank you very much for coming on. I'm looking forward to the next podcast when you're interviewing Google Bard.
Yeah. No, mate, I appreciate it. You've definitely done one for the humans, so I appreciate it.
All right, thanks.